Jeff, I hear defined benefit pension plans. That's the kind that government workers have and a lot of people in the corporate world. I hear they're getting into more interesting and arcane stuff in their investment portfolios. Tell us about it.
Well, historically, corporate pension plans have been sort of 55% equities and 45% bonds. And because interest rates have come down over the last 20 or 30 or 40 years, it's driven that sort of stress in the bond portfolio side.
So bonds aren't paying very much in interest. They have obligations they need to meet. What are they doing?
Well, it's part of the bigger picture. So when you're looking at the equity and the bond part of it, on the equity side, they're typically using less Canadian equity, more foreign equity. When they're looking at bonds, less sort of vanilla government bonds, getting into more corporate bonds, non-domestic bonds, getting into mortgages.
Interesting. Now, what about private equity? I keep hearing about that having an increasing presence in defined benefit pension plans.
Private equity and private debt are just like public equity and public debt in terms of bonds, but they're not traded. So they're different animals in terms of looking at them in terms of their risk characteristics. They're not as liquid, so obviously they have to pay a premium for their illiquidity.
Is there a higher risk in those types of investments?
Not necessarily. There's more diligence required from the investor's perspective to see what the underlying investments are.
Finally, I wanted to ask you about owning hard assets. I hear about pension plans buying malls and bridges and that sort of thing. Can a wide variety of investors expect to find those types of assets in their pension plans?
Absolutely. I mean, real estate has long since been in the Canadian pension plan marketplace. These companies are also turning to global real estate, but they're also getting into things like infrastructure, buying gas utilities, toll roads, airports, railroads, which are very specific in that they have predictable income streams, they're ones that have high barriers to entry, and they don't have the same sort of asset value volatility that a lot of other asset classes have.
Final question, I want to circle back to the risk issue. We've talked about pension funds getting a lot more complex in their holdings. Do you think there's a higher risk level there?
Well, risks have gone up a little bit because people have had to take on more risk to offset the less income that's coming in from the fixed income side. So yes, risks have gone up a little bit, but very measured, very diversified, and obviously very necessary to meet the obligations of the plan.
Thanks, Jeff.
Thank you.